Bloomberg Audio Studios.
Podcasts, radio, news.
Hello, it's Maren Somerset Webb here. We've got a very special episode of Maren Talks Money for you this week. As regular listeners to the show, you will know gold versus Bitcoin is a debate we love to have on the show every week. In fact, it's how I end every episode. So we thought rather than just saving that question for the end of every show, we'd make an entire show around it. So this week we bring you the conversation I had with Charlie Morris, Chief Investment Officer and founder of ByteTree, and Alexander Charters, Fund Manager at Ruffer, in front of an actual real live audience at Bloomberg headquarters in London about which of these assets they would hold and why. But first, as always, senior reporter and author of the Money Distilled newsletter, which, by the way, is excellent. Sign up if you have not already. Written by John Stepek, and here he is with me to chat. John.
Maren.
John, who knows that we are a bit frustrated with him?
The list is endless. I'm not even sure who you're referring to.
Oh, come on. You must have listened to poor old... Well, you know how we used to say poor Theresa May? We're going to start saying poor Rishi Sunak. Poor Rishi Sunak, as he unveiled what they call a £17 billion package of tax cuts. He says, I am not blind to the fact people are frustrated with me. And he admitted that he's not got everything right. Now, I know you've looked at the manifesto. Is he ever going to get anything right?
Actually, you know what? The thing that they aspire to do, which is get rid of national insurance, is a good aspiration.
Why didn't they do it a decade ago, though?
Basically everything that's on the manifesto, you can either say, well, okay, if you think this is a good idea, why didn't you try it, X number of years ago? And a lot of things in the manifesto actually don't look that great. This idea of bringing back Help to Buy.
Oh, God. But it is interesting, isn't it? I have to interrupt because you mentioned Help to Buy, which presses every button. Every button. You know how sometimes people might make a policy and they think it might work and it sounds good and they haven't got actual evidence to show that it's a rubbish policy. Yeah? Help to Buy isn't like that because we've had it before for yonks and we know it's a terrible policy. We know that in areas of high demand, all it does is push up prices for first-time buyers. We know that. Why would you reintroduce it when you already know that it's a subsidy program for house builders?
I think that it's mostly because the voters it's aimed at, the first-time buyers, don't fully appreciate that. And you are absolutely right, by the way, because actually another side effect that Help to Buy had was it directly led to the Persimmon chief executive getting that massive pay package.
Oh, gosh.
And that in turn led to I think that was the tipping point for chief executive pay in this country. Yeah. And it became the point at which all the, the kind of advisory committees said, no, we're not having this anymore. And now we've got, the new regulator kind of pushing back against that and saying, well, actually, there's no law saying that UK chief execs can't have packages that are more like US ones. So that's interesting in itself. You can argue that, Help to Buy directly affected the health of UK capital markets by drawing attention to one particularly egregious
Well, it did, and getting us into a situation where we have chief executives across the UK talking about shifting their listing to the US so they can get paid properly, or just leaving and going to the US so they can get paid properly. Ashtead being the most recent example of that, right? Anyway, let's not get hung up on Help to Buy. John and I have written about this a lot over the years. Go back, read our columns on it. But basically, rubbish policy, not required.
Well, they're talking about building more houses again. And kind of like, well, okay, that's fine. But again, you have been in power for 14 years.
Yep.
For whatever reason. Now, whether you think building more houses is a good idea or not, and I actually think it's more about reform and planning than necessarily saying we have to have this number of houses. And I think actually that will probably quite often lead to disaster because you build houses where people don't actually want to be.
Yeah, whereas if you reform planning, the market will give you houses where people need houses.
Yeah, exactly. But it's kind of like, well, why do you think that saying that you're going to build 1.6 million is somehow going to magic 1.6 million houses out of nowhere when you've been saying we want to build houses? It's not as if this is a new commitment. It's not as if they've turned around and said, oh, we don't like building houses. Now they're going to find the magic key to do it. I just think it's that sense that you're going to get more of the same. There's all the kind of kidding on about fiscal responsibility as well, which is the irritating thing. Because obviously all of this is going to cost a bit more money. And so they're saying, okay, well, where are you going to raise the money? And we're going to raise the money, I think it's $6 billion in tax avoidance, which is, you're kind of like, well, look, again, if that $6 billion is just sitting around, how come you're not already collecting it?
Yeah, why didn't you pick it up last year or the year before or the year before if it's just been sitting there down the back of the sofa waiting for you?
Exactly. And then it's $12 billion in welfare reform. And, while, I'm sure I'd be among the first to say, yes, I'm sure there are areas where we can do welfare reform and where it's inefficient and all the rest of it. The question again is, well, why are we at the situation where there's apparently just 12 billion lying around to be picked up from the kind of benefit system, and what have we been doing without it, for the sake of what? It's like, why are you suddenly going to get more efficient if we vote for you now? But it's one thing if Labour says stuff like this, because although they're almost certainly talking rubbish as well, at least they haven't actually been in charge for any period of time.
Yeah, so you can't say to them, why didn't you do it before? Now, listen, one of the things that you and I have talked about a lot is the narrowing of the tax base and the percent of taxation paid that comes from the people at the very top. And you pointed out to me earlier a really eye-catching statistic from the IFS, which tells us that a higher proportion of over 65s now pay income tax than working people pay income tax.
In 2010, 2011, it was 48% of over 65s paid income tax. And it's now 65%. Whereas the number of workers paying income tax has fallen from 61% in 2010-2011 to 58%. Now, it is expected to go back up to 66% by the 2029 tax year. But it just shows you, it's partly because pensioners actually did used to have a slightly higher personal allowance, but it's mostly because they've had pretty decent income growth. Whereas also, obviously, a lot of the Conservative Party policies have been aimed at taking the lowest paid people out of the income tax net altogether. Now, whether or not that's actually a good idea, and I think our view is that the problem is if you rely too much on the people at the top, because what is it? The share of income tax paid by the top 10% income taxpayers has gone up from 54% to 60% now. So you're becoming ever more reliant on a very small group of taxpayers to prop everyone else up.
Yeah, and you could always say that you have an awful lot of people who by not paying any income tax at all maybe don't have quite the same stake in how taxation revenues are spent than other people. It's an old-fashioned argument, but I think it's still got some validity to it.
Yeah, you're right. I broadly agree with that, because I think when people go from not paying tax to suddenly paying tax, they get a kind of wake-up call. And the problem is if no one at the kind of minimum wage jobs is actually paying income tax, then you're right. I think there's a lack of participation in a funny kind of way.
Well, I say that just because I'm fascinated by when, the young people around me, when they get their first job, waitressing or whatever it is, and they come home with their first pay packet and emergency tax has been taken out. And they look at it and they're like, oh, my God, they took all my money away. And you're like, oh, yes, they did. Yes, they did. And they're going to keep doing that for your whole life. And it's a horrible shock when they see that number and they realize that's how it actually works. They think they earned a certain amount. They've added up their hours in their head and they've added up their percentage of the tips, etc. Get the pay packet and half it's gone.
Effectively, what you're saying is they instantly become somewhat more conservative. And yet it's been a conservative government that's pushed them all out of the tax envelope.
I think it was Nick Clegg who had this initial idea that you should get as many people as possible out of the tax net and they should make the allowance bigger and bigger and bigger so that fewer people at the bottom paid any tax at all. I remember discussing it with him once and saying, I get that. And, you're quite right. The more of anyone's money they get to keep, the better. But maybe if we all have to be part of this system, everyone should be paying even a tiny bit into it and understanding that they pay a tiny bit into it so they have some stake in how it's spent as well. I don't know. Philosophical arguments that are probably too much for this podcast. But I tell you what, John, you know what you need in an era of debt and deficits and political instability and changing governments here in Europe, in the US. Everything's a bit uncertain, a bit confused. I bet there's a lot more instability, inflation ahead. Do you know what you need?
I can't possibly imagine.
Welcome to Merrin Talks Money, the podcast in which people who know the markets explain the markets. I'm Merrin Somerset Webb. Let's get to my conversation with Charlie Morris, Chief Investment Officer and founder of Biketree, and Alexander Charters, Fund Manager at Rafa, at our special event in the Bloomberg offices in London. Canapes and drinks, by the way. Sorry you all weren't there. Focusing on the question, Bitcoin or gold? Now, as I mentioned, it's a question I ask all my guests. So here's a quick reminder of some of the answers we've received in the past.
I'd probably go for gold.
Bitcoin. Gold.
Bitcoin.
Gold.
Gold.
Hey, gold.
Gold for me.
Gold.
Gold.
It would not be Bitcoin, but I think I could do better than either, really.
So, overwhelming support for gold among the Merrin Talks Money guests, but not so black and white for Charlie and Alexander. I start the conversation by asking Alex, why is it that we're talking about holding assets like Bitcoin and gold right now? What is it about geopolitics? What is it about everything going on around the world that means that you need this kind of anti-fragile insurance asset?
I think the headline is we're in a period of extraordinary regime change for markets. We've had 40 years of falling inflation, interest rates, economic volatility, and very atypical geopolitical peace. And that was driven by things like China and the former Soviet Union rejoining the global trading system, massive positive supply shock, cheap energy, most favorable demography of all time, literally, small state revolution, you name it, plus tech. It was all disinflationary. And so it's been manna from heaven for investors for 4 decades. You basically just have to hold something, equities, bonds, real estate, it's all gone up. And assets love low and stable rates and inflation. So if anything comes along to change that dynamic, the portfolio logic that's dominated the last generation also needs to change. So what's happening now? You've got fragmentation of world order, so retooling of supply chains because relations with China and the West are much more fraught. You've got more expensive and potentially volatile energy. You've got the big state coming back in large size in the economy with fiscal policy driving much more vol. Demography is reversing. You've got the biggest population bust of all human history. So if you put it together, you've got a more inflation-prone and volatile environment, and that means that you can't rely on things like the negative stock-bond correlation that's dominated for a generation. So you need alternative assets, real assets that are anti-fragile to get you through what we think comes next.
Okay, so basically everything that starts with a D has turned.
Yes.
Demographics, end of the peace dividend,
deglobalization,
deglobalization. Yeah. That's the big change. But we look around us now and we see inflation falling. And, thank you, Rishi Sunak has very kindly brought inflation back to nearly 2% for us.
Yeah, well done him.
I know,
amazing achievement. Amazing achievement.
Yeah.
Look, the key thing is inflation volatility. So no one's saying it's not going to come down. It's just that probably in the era ahead, the floor will typically be 2% inflation rather than a 2% ceiling as we had for the last generation. And you only need very small changes in the amount of inflation around to fundamentally change cross-asset correlation. So in plain English, when there's not much inflation around, bonds and equities tend to be negatively correlated. So your bonds go up when your equities go down. But for most of history, if I drew a chart of that back to the Napoleonic Wars, you'd find that bonds and equities tend to be positively correlated. So if there's a bit more inflation, it will be positively correlated more often. You need other assets. Enter the conversation tonight.
Okay, I want to ask you one more thing before we move on, which is you and I have talked quite a lot over the last 4 or 5 years about this regime change, about regime change in markets, regime change geopolitically, etc. And it's a story that I think we both feel is right. But what could happen to make you feel that this story is wrong, that perhaps it isn't so bad, that perhaps we're just going to slip back into the previous path and carry on as was?
There are a few things, but first of all, I wouldn't necessarily characterize it as bad. It's just different.
Okay.
And actually,
I'll entirely give you that. Different, and there are lots of good things about it too.
Exactly. So it's just a different opportunity set and a different set of assumptions. What could change if you had dramatic change in relations between the US and China, if you had a monster productivity miracle around, say, AI, if there was some sort of other technological deus ex machina that solves the problem. Unfortunately, given the massive debt situation, because as those rates fell for 40 years, debt ran up, and people didn't think it was a problem because the cost of servicing that debt was also very low because rates were coming down. But of course, now rates have gone back up, people realize it is a problem, and paying for the reversal of those Ds that you described earlier is very, very expensive when you've already got debt to GDP ratios at all-time highs and the debt service ratio shooting up quickly.
Okay. Charlie, when you look at this situation that he's outlined, is that how you see it?
Absolutely. I think that when you have a large, high debt to GDP ratios and you've got structural deficits and it's a year of elections and no one is talking about bringing down the deficit, not a single actor in any parliament here or in America or in Europe cares about budget deficits anymore. So it's only going one way. And I'd also say that the money supply has been, growth has been very, very low in the last few years around the world. And what we've seen is, quite impressive behavior from asset prices, despite the fact there hasn't been vast amounts of money creation since 2021. And that really tells you that the pent-up demand for inflation once they start printing money again. What would happen in that environment?
Okay, so we can't trust fiat anymore. Or not that we ever could trust fiat, but we're in a situation where we can trust fiat even less than we've been able to over the last couple of decades.
Fiat money is brilliant if you treat it carefully. And there are some countries that really don't, and we've seen what happens there in places like Turkey and Argentina.
Do we treat it carefully?
No, we don't. We once did, but we don't anymore.
If you go back to 71, when Nixon pulled America off the gold standard, you had a price of $35 a troy ounce. And the price on the screen when we do this podcast is $23.30. So you've lost, in the principal reserve fiat currency of the world, you've lost 98% plus of your value.
Okay.
Don't trust fiat.
Don't trust fiat. Anyone trust fiat? No one trusts fiat. Right. So in this environment, we can't invest in the way that we have or the way previous generations have. We can't look back at the last 40 years and say if we replicate that, we'll be absolutely fine. So what does, let's go back to you, Alex, what does a portfolio look like now? What should it look like now?
Well, it's going to have a wider range of assets in it probably than the traditional equity and bond setup that's done so well over the last 25 years or so. That means using commodities more often. It means using FX. It means using anti-fragile assets like derivatives, which in a world where you've got higher correlations between cash assets, if they all fall together and you want to protect yourself, you need derivatives as well. And of course, Marion, that will include anti-fiat assets, investments in a bear market in institutional trust, as Bank of America memorably described it. That includes gold.
Okay. Explain to us briefly what you mean by anti-fragile.
Things that profit from volatility and instability in these situations. So you don't just want to survive the sort of stress that the system will throw at you. You want to be able to thrive.
Okay. Portfolios. How different do they look to you in this environment? I mean, I know that you focus at the moment mostly on Bitcoin and gold, but obviously you have a long history of investing in all sorts of things.
I still do that, Mary, by the way.
Sorry.
So
I only read your gold and Bitcoin stuff now.
Yeah, we're talking about gold and Bitcoin today. But of course, I think that if you can take a more resilient approach to portfolio management than normal, obviously we're in extraordinary times because we've got these indices. It's very, very popular these days to track indices and have a passive portfolio. And low fees, a theme of this podcast, have always sort of come to fruition through that. But then you have a huge concentration risk, and it's not just the S&P 500 or the Nasdaq that's concentrated. The FTSE is half the FTSE is 12 stocks, and you see this all over the place. And I think if you embrace good old-fashioned value fundamental investing, you're in a better position because you're prepared for the unknown. You don't know what's going to go wrong and when. You just know that it will at some point. And greater diversification. As Alex has said, if bonds and equities are basically correlated, then that means when one goes up, the other one, goes up as well, and they go down together. That's what it means. And so therefore, you need to find other additional sources of diversification. The traditional one is gold, and now it's got a friend called Bitcoin.
Digital gold.
Digital gold.
Digital gold. Right. Okay, well, why don't we talk about gold? You're both obviously itching to talk about gold. I can't keep you off it. Right, so Alex, why gold?
It's got a
And why gold now?
5,000-year pedigree of being the hard money choice. It's the preferred neutral FX asset, and there's no counterparty for it. It's inert, it has a low amount of additional supply every year versus the stock, which keeps it hard money. And crucially, at the moment, you can see people voting with their feet. So one of the most interesting things in markets is always stealth bull markets that are not liked and are not widely observed. And of course, Western investors have been selling gold, if you look at holdings of bullion ETFs, for example, because rates have gone up. But gold has decoupled from its traditional relationship with real interest rates on the dollar. And that's basically because there's a new big cast of buyers that aren't so interested in that. China in particular, India to a lesser degree. In China's case, it's especially central bank and retail. Why are they doing it? They don't trust the dollar anymore. So that's a canary in the coal mine for monetary change. And they are still going to this asset of choice. And that is likely a structural trend in a more inflation-prone and volatile environment.
Okay, let's talk a little bit more about that. Why does it make sense for central banks to hold gold?
Well,
you say you don't trust the dollar, but how does this work?
If you hold most of your reserves in US dollar assets, you're ultimately in the hands of the US authorities. And as you saw after the invasion of Ukraine, what the Russians discovered very quickly, which they didn't expect, is that those reserves got confiscated. Mm-hmm. So part of the system over the last 40 years has really relied on the recycling, more than that actually, 50 years, has relied on the recycling of excess surpluses from the rest of the world into US dollar denominated assets. People don't want to do that so much anymore. They don't have confidence they're safe. So they want to own a neutral FX assets that Uncle Sam can't control. And gold is therefore taking up a larger share of reserves.
It's neutral. And what does that mean?
Well, can I come back on that question as well? Because, gold's had many different roles over the years as official money, and it's had time as being official and time as being unofficial. And we can start the conversation shortly before 1971, as Alex mentioned. And really, gold was the original financial technology, the original fintech. Because if you went on a sailing ship to the other side of the world and you were trading something, this piece of gold was pretty hard to forge. I know there's tungsten and things like that, but actually you could tell gold was gold, and therefore it was a technology that transferred value equally and fairly around the world. It was a pretty powerful idea when you think of it in those terms. And the 1971 system, there are lots of reasons why it happened from Vietnam money came to be, but one of them was technology. Finally, we had telephones and computers that enabled to have a sort of real-time Bloomberg-y type buy-sell system of lots of information and data. You couldn't really have done it in quite the same way and the same scale much before that. Computers weren't good enough. And so I think that's something worth remembering. And so as it started to work, and as the inflation of the 70s cooled down by 1982, you had 2 decades where gold was completely irrelevant. Having been a 27 bagger in the 70s, it was irrelevant for 2 decades. And I think it found its metal fundamental value by 1999. It was irrelevant in central bank circles. Gordon Brown had sold ours. Many European central banks had reduced their holdings as well. But, at that point, that was the low. And then slowly but surely, people started to pick up on their interest in gold without any formal declaration. And by 2009, after the credit crisis, the emerging market central banks went, do you know what? It's not such a bad idea after all. It had already gone from $250 up to about $1,000 at the time of the crisis. And then they started accumulating. And they've been accumulating every year since 2009. And it's recently started to accelerate. So I think you've got to sort of wonder why this asset, and it's not written down anywhere that central banks must own gold. But they just chose to, particularly in the fast-growing emerging world. It's only in the West where we've sort of lost interest in this asset. My final point is that in 2010-11, and I remember it clearly, being a portfolio manager in London back then, everyone was all over the gold ETFs. It was big news of how big they'd become, and people were showing off their allocation. And today they can't sell it fast enough. The wealth management industry, the pension funds, and so forth have given up on gold.
So there is still money flowing out of gold ETFs in the West, right?
Correct.
Yeah. I do think it's interesting you say about central banks holding gold, because it is one of the things that we don't really talk about much. Everyone sort of accepts that central banks hold gold, but if you stop to think about it, it's actually quite strange.
Well, it's not strange if you look back.
It's not if you look back, but if you were to sit down and say, they don't hold dollars anymore, or they're cutting down dollars, and they've got big piles of gold,
Unless they know something we don't about commitment to the value of fiat currency, which is, of course, what a cynic would say.
So there's one other point about gold we haven't mentioned. It's a massively liquid asset. Liquidity itself is hugely valuable. And according to the World Gold Council, the liquidity of the gold market is $145 billion a day, which is not far off the S&P 500. Bitcoin, which I'm sure we'll come to, is also a highly liquid asset. So, what Alex has been talking about is, allocating to different things in the portfolio, anti-fragile assets and so forth. Commodities. But a lot of commodities are not particularly liquid. The frozen concentrated orange juice in Eddie Murphy's best film of all time, for example, is not a particularly liquid asset, even though it is a liquid. Art is not liquid. But, the two most liquid alternative assets in the world are Bitcoin and gold.
We'll come back to Bitcoin, Charlie, I promise.
Sorry, I'm itching to go.
But what we've just been talking about, the fact that the main buyer of gold at the moment is central banks, and that's what's pushing up the price, that rather explains why we're not seeing much action in, for example, the gold miners. So normally when the gold price goes up, retail investors like us, we will rush out and buy gold miners, right, because they're going to follow. And this time they kind of haven't. Yes,
well, it's actually Alex who said it in the green room, so I'm not going to take his idea. He said that the Chinese are buying gold. So it's a retail investor in China. Don't have a lot of choice in what they can invest in. We in the West have much more choice.
And retail investors in China are buying, I keep reading, little gold beads.
Yeah, that's right. I mean, look, fundamentally, everyone is going to want to own lots of stuff that governments can't print, because we're going into a world where to pay for those Ds, the government prints paper to buy real assets, ultimately that finds its way into copper and things like that for the grid build out and rearmament and so on. So I think people are sniffing this out in their various ways. And in the West, if you get lower rates and Western investors coming back to gold for any reason, that's an additional kicker. Now, we should say short term, all this stuff has obviously run pretty hard. So don't be surprised by a significant pullback. But we are talking about long-term trends here. So with the right time horizon, it's interesting.
Okay, so should we, as retail investors, should we be buying bullion? Should we be buying coins, keeping them at home? Should we be buying ETFs? Should we be buying miners? Should we be buying mining ETFs? What should we be actually buying to reflect our interest in gold?
So on the relative value trade, which is the cheapest historically compared to where gold is, silver and miners are obviously offering a lot of good value there, but they're only going to do well if gold goes up. So if gold's not going to go up, then steer clear, because they're not going to catch up with gold standing still. But I do think that it's also worth looking at the volatility of these things. The gold miners are basically more volatile than the Bitcoin now. And as Alex was saying in the green room, the Chinese private investor is not buying gold mining shares. They're buying gold bullion. They're not buying silver either. And so you've got to think who's buying it. And it's the West. And of course, the West aren't buying gold, so they're not buying gold miners either. And so I think we've had no inflows into the gold mining ETFs for 10 years or something like that. And we've had outflows from gold. But to me, that's all bullish. They're just too cheap. We know why they're cheap. Because no one believes the gold story, or not enough people believe the gold story. But there are plenty of sound reasons why it's underpinned massively. So I would think silver and the miners are a very good thing to do. For gold itself, absolutely. For the conservative investor, that's what they should be doing. And the ETFs are fine. There are conspiracy theories about ETFs all the time. You don't need to listen to them. They're not true. ETFs are fine. But if you want to own bullion or metal, the metal itself, as a British citizen, own the sovereigns because they're tax-free, capital gains tax-free.
Got any favourite miners?
Torex would be one in Canada, and Centamin, in Egypt, the London listed in Egypt. I think they would be quite good choices.
Okay. And Alex, in the fund, you hold gold how?
We've got about 10%, maybe a bit more, across precious metals exposure in the round. So about 5% of that's gold miners. Most of that is through our in-house gold mining fund, which has a range of small and mid caps. We've also got a decent position in Newmont, which is the biggest gold miner in the world. We also own some silver bullion. Silver bullion traditionally has a beta of about 1.6 to gold, which means that it tends to move in a magnified way, 1.5 times up or down whatever gold's doing. And there's a very interesting long-term fundamental story there. 80% of silver is created as a byproduct of other metals, and demand is going up on the industrial side. We've also got a bit of platinum in that space as well, which is 20 times rarer than gold. So we've got a bit of a spread, but gold miners and silver offer effectively leveraged exposure to the gold price.
Okay, brilliant. Right, we've covered gold. Good news, Charlie. We can turn to Bitcoin. Tell us the Bitcoin story.
So Bitcoin was designed around the idea of gold, limited supply. And so the supply side characteristic of Bitcoin is very, very similar indeed. In fact, the new supply growth of Bitcoin now is slightly lower than gold, but so what? The important point about Bitcoin is that it's a neutral asset like gold. It's respected down the world. It's very, very liquid, very, very, very liquid, unlike many other so-called cryptocurrencies. And it's the real deal. I think that some people would be very skeptical because it's got no physicality about it. Well, there is a physicality in two forms. One is the energy intensity. There is a sort of real world part to the Bitcoin story. If it was easy to mine Bitcoin, it wouldn't be valuable. If someone was in control of Bitcoin, you could make Bitcoin really, really easy to mine, or rather, you could maintain the limited supply, but there'd be a controller of some kind. There'd be a sort of board or a CEO or whatever. Then it's not an independent asset. So I think that if you want it to be taken seriously, the design is as it is. The physicality, the lack of physicality doesn't matter because you don't really own a Bitcoin, a thing. You own a share of a valuable network. And that hugely valuable liquid network is what it's all about. And if you're wise enough to own a little bit, then that's your prize. You have a little bit of that. I mean, Warren Buffett once said, I wouldn't pay $20 to buy all the Bitcoins. Sorry about the accent.
That's right.
But I wouldn't pay $20 to buy all the Bitcoins. And if you, whatever you paid for all let's say you wanted to buy all the Bitcoins, and you had the money to do that, then you would soon have zero money because you've destroyed the network. It's a bit like owning all the telephones. So who are you going to call? So it's a very simple idea. This idea of a network is valuable.
So the value is in the energy intensity of its production.
The energy intensity of
its
production is its security.
Okay, because that's what tells you that it will always remain scarce.
Yes. Well, the scarcity can be baked in. You can copy the code, and Bitcoin code is freely available on the internet. You help yourself. You can go and launch your own, give it a name, and good luck. It'll be worth $1 trillion. But it won't be worth $1 trillion because 20,000 copycats have failed. There can only be one network.
Okay. So let's ask about the use case because we have to do this. For the likes of us, what does Bitcoin do for us that we can't do already with products and networks that already exist for us?
Which country do you live in?
Good answer.
So, there are many use cases for Bitcoin. And I think if you look at its price correlation, so it is liquid, that's a fact. Its price correlation is very, very high with tech in general. It used to be social media stocks that stood out. And what are social media stocks? They're basically people using the internet. The price of a social media stock is a sort of measure of how many people are using the internet. And they sort of moved on to more tech in general, and now they're sort of hanging around NVIDIA quite closely, and the big companies in particular. So, it's quite obvious that what is Bitcoin? Well, it's something to do with the internet. Well, it comes from the internet, and it correlates highly with these things. It's part of the tech revolution. You can't cherry pick which bits of it you like and which you don't like. You can't say, I think AI is really good, and having my NHS online is really useful, and I like the taxman online. But then, I don't like Bitcoin, or I don't like this or that. I mean, there are many things on the internet.
Freudian slip, Charlie. Yeah.
The evil as it will now be known.
Some of them are very, very evil indeed, and others are, fabulous.
It's not about liking or not liking. It's about, I understand what you mean. You say which country you live in. What you mean is that in unstable countries, it's a great way to be able to hold and transfer wealth, right? That's what you mean. And we don't understand that because we don't have that problem.
Absolutely right. You can cross a border and remember a few words, and that's it.
Yeah. Okay.
Your money is intact.
Okay, let's look at it another way then. When we talk to people about Bitcoin on podcasts or anywhere, people are very evangelical about it and treat it as you say, as an asset that is respected everywhere and now used as an asset. What would have to happen to make you no longer feel like that about Bitcoin?
What would have to change for you to no longer feel that Bitcoin was an appropriate asset for people to hold, that it existed as a thing, because we look at it and we say, well, what is it? It's not a thing. We call it, digital gold. We call gold physical Bitcoin, makes us laugh, etc. But what would have to change for your bullishness on it to change? I don't mean your bullishness on its price. I mean your bullishness on its existence. So, for example, is it a change in regulation? We worried for ages, or Bitcoiners are worried for ages, that Western central banks won't allow Bitcoin to exist. And that ship seems to have sailed a little bit. We wouldn't have ETFs, etc. But what is it that would make you not think that Bitcoin would continue, but that it would fail?
So I think network exhaustion. I think everyone just got bored of it. And so far, we've had lots of bull and bear cycles in Bitcoin, but the bear cycles have been absolutely devastating. But it comes back bigger and stronger every time. And I think that if the liquidity started to fade, which it hasn't done in past bear markets, it really hasn't. And that's been so amazing. The price has gone down, but the liquidity has always been there. And so genuinely, if people just got bored of the whole idea, which, by the way, would also mean they got bored of the internet, AI, and all of that stuff too, it's quite possible, then I think that would turn me off. Certainly tactically, cyclically, not sure whether it be structurally. But if the liquidity of Bitcoin evaporated, it's worthless.
Okay. Alex, Ruffer had a little dip into the Bitcoin market a while ago and sold out very quickly, hasn't gone back in. How do you feel about it now?
Well, look, for all the structural reasons, it's interesting for a lot of people. I think generationally, there's a bit of a thermocline between gold and crypto assets as a way to protect against fiat debasement. So never say never. The thing about Bitcoin is that it's the beneficiary of the marginal liquidity in the system. In other words, how much money there is sloshing around the system makes a big difference. And if anything causes that liquidity to retreat, Bitcoin is likely to go down. It's really a kind of risk-on asset. Charlie talked about its correlation to tech earlier. If you put up a chart of 3 times, bless you, leveraged NASDAQ, you'd find that it's basically the Bitcoin share price. So portfolio balance is important. We've got lots of things that give us a lot of bang for buck against the sorts of things that people say Bitcoin is long-term defense against. So never say never, but we're nowhere near it at the moment.
You got any personally?
No, I don't, no.
How should we hold it personally, Charlie? I mean, people who listen to the podcast will know that technically I'm the owner of a perfectly reasonable amount of Bitcoin. I just have absolutely no way to access it.
I think
lost my code twice.
I forget the numbers, but there are a lot of people in this country do own crypto themselves, and it's been very, very popular, particularly amongst people who are under 40 years old. And they're much more comfortable with the idea of a virtual digital asset than older people. And this starts with computer games, where you can buy. I mean, I don't know anything about computer games, but I gather you can buy a sword, and this has been true for years. So if you have some character,
I don't think you know nothing about computer games. I reckon you know quite a lot about computer games.
I know nothing, actually. I really do know very little. But you can buy swords and hats and weapons and things. And so if you've been brought up thinking that's property, then it is property. And the whole NFT revolution was pretty interesting. And I don't own an NFT, but I can understand why people would value an NFT as the original. So you own the first one with the hash and all the rest of it that says this is the original picture of a laughing monkey or something, and that's fine. It is the original. And the same way that you want to own a nice piece of art, you wouldn't want a print or a copy. You would want the original. And so I do understand that, even though it's not something I personally get involved in. And I just think there's so many things happening in this space when you want to have property transferred across the internet, tokenization, the stable coin. Think of AI. Imagine 2 big mega computers talking to each other in the early hours of Sunday morning, and they're doing some complex transactions. Are they going to use a traditional bank account? I very much doubt it. They'll be using stable coins and Bitcoin and things like that.
You've brought up the thing I want to move on to very briefly by mentioning AI and mentioning all these kinds of things. Energy usage. There's a lot of talk about the amount of energy that Bitcoin uses up. As you say, its value is partly in the energy that it uses to be created. And then, of course, it consistently uses energy. And one of the things about gold is that, sure, a lot of energy is used to drag it out of the ground, but then it exists effectively as a store of that energy to a degree. It doesn't continue to use energy. So Bitcoin is a user of energy in a time when we're fairly desperately trying to use less energy?
Well, we don't want to use less energy because the advancement of mankind economically has always coincided with consuming more energy.
No, absolutely. I entirely agree with you. I'm simply saying that the political imperative we're being given is to use less energy.
Yeah, but those political people, in the next sentence, they'll say, I don't understand the productivity problem. And so you can't have a productivity revolution without more energy consumption. So, and it's very strange that politics doesn't seem to, of course they understand it, they just don't admit it. They say something different. But back to your point, the gold does consume approximately the same amount of energy as Bitcoin today in terms of mining. You can switch off the mining and you still have lots of gold. But again, we're coming back to this idea that gold's a thing, not a vibrant liquid network. If everyone has a whole bar of gold in their garden hidden underground, the rose bush, is that a vibrant liquid network? No, it's just a piece of metal under your rose bush. And that is quite an important point, I think, to understand. If you go back to 1999, I was saying that was the sort of end of the gold market. It was sort of dead at that point, $255 an ounce. And then it all turned. And I think that's the fundamental gold metal value discovered in 1999. Now, slap CPI on top of that, you get to about $500 today. That's what gold, the metal, is worth. Gold, the monetary network, is a different thing. And it trades at the same price.
I think it's 2,400.
Sorry?
Talked yourself into gold.
I have an index called Bold that combines both of them.
I know, and it's absolutely brilliant. And I'm going to let you talk about that very briefly in a minute. But before we get to that, I am actually going to make you choose. If you had to choose one, Charlie, if you had to.
What do you think I'm going to choose?
Gold.
Of course I'm going to choose gold, because the Bold index is 3/4 gold and 1/4 Bitcoin. So I'm going to go with the majority.
Alex?
I'm afraid I'm going to say gold as well, Marion. Very consensus.
Okay. 1 minute on Bold. How it works.
Yeah, so
actually more like 30 seconds.
Well, I followed
some questions.
I followed the gold market for 25 years, and when Bitcoin came along in 2012, I thought, how ridiculous is that? You can cut and paste it. I realized I was wrong in 2013 and got very excited. And over time, I've been writing a lot about these things on Bytetree.com, and I realized that one was risk on, one was risk off. Through my fund management career, I've come across things like volatility weighting and this sort of thing. And you realize that if you allocate less money to the more stable asset, the ballast in the ship, and have Bitcoin as the spinnakers of the sails or what have you, you end up with something that's pretty special. So the Bold index is a very nice way for people to own both assets, and it maintains risk and it adds a little value. So something.
But it's got more gold in it than Bitcoin.
Of course it has. unless Bitcoin becomes, the money of choice for central banks in 50 years' time, then the index will adjust for that.
Now that would be interesting, wouldn't it? Thank you very much for joining us, and please help me in saying thank you to our guests. Thanks for listening to this week's Marion Talks Money. We will be back next week. In the meantime, if you like our show, rate, review, and subscribe wherever you listen to your podcasts. And keep sending questions or comments to marinmoney@bloomberg.net. As ever, we are interested on your views on Bitcoin and on gold. If you disagree with Charlie, if you disagree with Alex, let us know. This episode was hosted by me, Marion Somerset Webb. It was produced by Sam Asadi. Additional editing by Moses Andam. Special thanks to Charlie and to Alex.